5 ways to save massive taxes through real estate investing. Rental real estate, one of the best ways to save on taxes and build wealth. And how do we know this? Well, because most wealthy people have real estate as one of their main asset classes in their portfolio. So let's take a look at why that is and how we can utilize that to our advantage to build wealth and save massive amounts in taxes. The first reason why wealthy people invest in real estate is cash flow. On average, research shows that investors will get 8% cash flow if they're investing in the right areas. Ultimately, real estate investing is a great way to have your money work for you instead of you working for your money. You're going to buy rental real estate, put tenants in there, and what they will do is they'll be paying you rent. So the money that they pay you then helps to pay down your loan, and if there's additional amounts, you'll get cash flow from that property. It's one of the few asset classes where you can generate rental income or cash flow on a month-to-month basis. And the wealthy love to do that because it's all about putting your money to work for you. The other reason why wealthy people love to invest in real estate is appreciation. You buy a property and over time it will appreciate in value if you're doing things correctly. Research shows that real estate appreciated an average of 3 to 5% per year in the last 10 years. Now, as we all know, in some areas it was actually even much higher than that. It is really key when you're investing in rental real estate to make sure that you're investing in the right areas. In some cases, you can even create what we call forced appreciation. So that means you're not just passively waiting for the property to appreciate based on market conditions, you're actually creating appreciation by improving the property itself. So if you bought a 1-bedroom, maybe you do some rehab to make it a 2-bedroom. You bought a property that's run down, you fix it up, and you are able to charge higher rent. So there are other ways to show forced appreciation to get it even higher. But even without that, historically, at least in the last 10 years, we're looking at an average of 3 to 5% per year in rental real estate appreciation. Now, the third reason why wealthy people love to invest in real estate is that they understand the game of leverage. Real estate is one of those asset classes where it's highly leveraged. You can get into properties with 5, 10, 20% down payment, and the bank will help you finance the rest of it. The good part about this, when there is appreciation, because you are the property owner, 100% of that appreciation is your earnings or goes towards your net worth. So this is one of the reasons why wealthy people typically love to invest in real estate, because they get to leverage other people's money like the bank or investors and get that to work for them. All right, the other reason why wealthy people love to invest in real estate, and this is going to be the bulk of our conversation here, is tax savings. This is a huge one. If you think about it, people who are high income or high net worth are often the ones who pay the most amount of taxes. Depending on what state people live in, the highest federal and state taxes can take away more than 50% of their earnings in taxes. And so if you think about someone in that profile, tax savings is super, super important to them. And so for wealthy individuals, they understand that real estate brings them a lot of tax savings. And this is one of the main reasons why most wealthy individuals have real estate as one of their asset classes. So how do we get tax savings through real estate? We'll take a deep dive into what are some of the things that we can do as real estate investors? What can we write off? How do we optimize our paper losses on rental real estate? And last but not least, how can we use it to offset our income, not just from the rentals, but also our W-2 and maybe our business income as well? As real estate investors, we are business owners in the eyes of the IRS. So what that means is we're able to take business write-offs against our rental income. Unlike income from our W-2 jobs where we have very few write-offs, rental real estate opens up a whole world of tax deductions for us. Anything from being able to write off our home office, where we might manage our rental real estate from, to driving our cars to our rental properties or to meet with other investors, and a slew of other things that we use on a day-to-day basis for our rental real estate, like laptop, cell phones, and a bunch of other gadgets. So being a real estate investor opens up the doors for us to have all these write-offs to offset the rental income that we're earning. So again, if you're someone in a high tax bracket where you were paying over 50% federal and state taxes, now as an investor, you can start to generate rental income and not pay a whole lot of taxes on that money. Exactly how much are we saving? Based on what we see, more than 90% of investors actually don't pay taxes on any of the cash flow earned by their rental properties because of all these legitimate private business write-offs, and things like depreciation, which we're going to cover in just a moment. The second reason why rental real estate is really great for tax planning is that appreciation is generally not taxed every single year. So for example, you buy a property for $200,000, the next year the value increases to $230,000. Now you have a $30,000 gain in this property that you own. Well, the good thing is you typically don't have to pay taxes on that $30,000 gain because you haven't sold it yet. And so if you think about holding a property with 3 to 5% gain every year for the next 10 years, that's a lot of equity buildup that you don't have to pay taxes on that immediately. Conversely, with any kind of earned income from your W-2 or from your business, that income typically you have to pay taxes on it every year when you earn it. So this is another great benefit of how owning real estate can help you to build wealth without paying taxes every single year on the appreciation as they incur. And in addition to that, which will bring us to our third tax benefit, which is depreciation. So even though in reality rental real estate is appreciating in value, we actually get to take a depreciation deduction, which is allowed by the IRS. And this is true even if the property value is actually going up. So what exactly is depreciation? Well, depreciation is a paper loss that the IRS allows us to take. Basically, what the IRS's position is when you buy a rental property and there is a building on the real estate, that there's going to be wear and tear on the building itself. So over time, there's going to be wear and tear. So they allow us to take a depreciation every single year on the building purchase price of the property. Typically for residential real estate, they allow us to take it over 27 and a half years, little by little. If we're talking about commercial real estate, it's usually allowed over 39 years. Now, what's really interesting about depreciation is that not only does the IRS allow us to take depreciation write-off even though the property might be going up in value, it's actually a requirement. So it's not like we can choose to take depreciation or not to take depreciation. The IRS literally says you are forced to take depreciation tax benefit. And this is one of those benefits that allows us, again, to use rental losses or create rental deductions to offset the taxes that we would otherwise be paying on our rental income. Not only do they allow us to take depreciation on the rental real estate, IRS actually allows us to be able to optimize and choose how we take depreciation. For example, we don't just have to take our depreciation of our building over 27 and a half years. We can actually use other strategy like cost segregation to accelerate our depreciation. This is where we say, instead of writing off everything as building over 27 and a half years, let's look at the building itself and break that down into its own components. Depending on what type of components there are, part of that would be furniture and fixture or specialty plumbing, we can take even faster depreciation, maybe over 5 years, 7 years, 15 years, or even immediately. So oftentimes when you hear investors say, I bought a bunch of rental properties, I created a lot of tax losses, or I didn't pay taxes on it, it usually is a result of strategic planning with respect to depreciation, and not that they're actually losing money on their rental real estate. What that means is typically what we'll see, at least in the first couple years of someone investing in rental real estate, that will actually have tax losses. What we mean by that is we're gonna have good cash flow and good appreciation on the property, but when it comes to tax returns, the IRS is actually going to see a loss. And so the next question then becomes, what happens with those losses? What kind of income can we use to offset that against? Is it just rental income? Is it other passive income? Is it W-2 or our business income? And the answer to this will depend on how the passive loss rules apply to you. So let's get into what are passive loss rules. What's really interesting is that passive loss rules are something that's somewhat new. It didn't actually always exist in the tax code. It actually came about back in the 80s. So back in around 1970s and early 80s, there were a lot of people who were contacting high income earners like attorneys, medical professionals, and trying to sell them real estate investments. Because they understood the concept of using depreciation and rental losses, what they were doing was they were visiting doctor's offices offices and saying, hey, I have rental real estate. Why don't you invest in my rental real estate? It's LLC or LP. And what's going to happen is you're going to get all this cash flow and appreciation. And meanwhile, I'm going to give you all these depreciation losses, and you can use it to offset taxes from your W-2 or from your medical practice. And that worked out really, really well for quite some time. Then the IRS caught on to it and said, wait, this is not good. We have a lot of high income earners. Everybody is getting into real estate. No one is paying any taxes. So they came out with the passive loss rules. And so when the passive loss rules came out in the late 80s, basically it was intended to prevent people who were just investing in real estate on the side, like that was not their full-time profession. It was designed to prevent those people from being able to use rental losses to offset income from their W-2 or other businesses. And this is such an interesting thing to go through the case history of how this came about, because my father-in-law, who is a retired physician, in fact, was one of those people back in the 70s and 80s who invested in a lot of real estate and was able to receive all those tax benefits. But unfortunately, that is not the law today anymore. Today, we have those passive loss rules in place. So now we have to think about how are we able to utilize our fact patterns to avoid those passive loss rules when we can. What are the passive loss rules? Well, basically, the passive loss rules with respect to rental real estate is aimed to say, if real estate is just a side hustle for you, that is not your main activity, and you have rental losses, then those losses only offset taxes from other passive income. In other words, those losses no longer offset taxes from your W-2 income or from any businesses that you actually run. So let's first talk about what are passive income that we can use rental losses to offset. Some examples of passive income would be other rental properties. So if you have losses on one rental property, you can always use it to offset income from another property. And this is the same regardless of whether your rentals are held personally or through an LLC. So for example, if I have a rental loss that I have invested with other people, but I also have income on my own rental property, they can always offset each other. Passive income also includes investments in non-real estate things too, like businesses. So if my friend has a business, I am investing passively in that business. And to the extent that that's giving me taxable income, I can use passive rental losses to offset taxes from other passive business income that I may be generating. Passive losses can also offset taxes from capital gains of those passive activities. So for example, if I have passive rental losses and there were other capital gains from sale of other rental properties, I can use those to offset each other. If my friend's passive business that I invested in also sells and there's passive capital gains from that, I could potentially use my rental losses to offset those as well. The key word here is passive losses offsets all types of passive income. Now, let's get to the heart of this, which is, what if I don't have passive income? Or what if I just want to do better, right? I want to offset not just passive income, I actually want to use rental real estate to offset taxes from my W-2 income. So there are a couple of ways to do that. First, if you are someone whose income is $100,000 or $150,000 or less, you can actually use up to $25,000 of rental losses to offset W-2 and other income. And this is true for everyone. Okay, this is part of the passive loss rules. As long as you're active with respect to rental real estate, you can use up to $25,000 to offset W-2 and other income from all different sources. Now, if your income is over $150,000 and you have rental losses, then there are a couple other ways that you can use rental real estate to offset your other income. One of which is the real estate professional status. You might have heard this a lot. Real estate professional is basically a way that allows high income earners, again, those people who make over $150,000, to be able to use rental losses against their W-2 income. Now, the common misconception for people is they think that real estate professional means I have to be a realtor or a broker and get licensed. And that's actually not true at all. IRS does not care whether you hold a license or not. You never have to hold an open house. You never have to go through showings on Saturdays. They don't really care about license designations. What they do care about, though, is a set of rules that basically indicates what you do with respect to real estate and how many hours you're spending with respect to real estate activities. So what are those rules? Well, to be a real estate professional and use rental losses to offset W-2 and other income, there are 3 rules you have to meet. The first one is you have to have at least 750 hours in real estate. And that could be all types of real estate activities. You could be a realtor or a broker. You could be in construction. There are all types of things that you can do in real estate to earn those 750 hours. The next role to be a real estate professional, which is probably the hardest one for most people to meet who have a full-time job, is that you have to spend more time in real estate than you do in your other jobs or business activities. So if you're someone who is working a full-time job at 2,000 hours a year, now you have to have more than 2,000 hours in real estate in order to be a real estate professional. And this is the part that's going to be very, very difficult if you are someone who works a full-time job. Now, alternatively, if you're someone who only works part-time, let's say you only work 1,000 hours a year, then you have to have more than 1,000 hours to be able to be a real estate professional. So for those of you who work part-time or reduced hours, this is something that's more of a possibility for you. But where we see this work out the best is for married couples. Let's say you have someone who one person is a high income earner and the other person is not working or working part-time or a stay-at-home spouse. In those scenarios, what would be the best is if that stay-at-home spouse can try to be a real estate professional. Why? Because that person does not have a second job, and so that person just has to meet that 750-hour requirement. And the third requirement is that you have to meet material participation with respect to your rental real estate, and this just means you have to meet a set of hours to be hands-on with respect to your long-term rentals. Why do we care about real estate professional status? Because once you or your spouse meets real estate professional status, then you can use rental losses to offset not just rental income, but also income from your W-2s and all other sources. And this is where things get really, really powerful. When you hear people say, I made $300,000 of income, I paid little to no taxes, odds are they are using this specific strategy. What's also really amazing about real estate professional status for married couples is that it works very well even if the spouse who qualifies as real estate professional is not the one earning the high income. In my example, you have somebody who is an attorney and their spouse is a stay-at-home. And so what happens is even though the stay-at-home person does not have that high W-2 income, as soon as that person becomes a real estate professional, the rental losses does offset that high W-2 income from the attorney that they're married to. So very, very powerful strategies for those of you who have a spouse who can't be a real estate professional or potentially wants to be a real estate professional. Now, the reality is not all of us are married to a real estate professional or could be married to a real estate professional. So I'm going to talk about the other loophole that allows you to use rental losses against W-2 and other income, and that is investing in short-term rentals like Airbnbs. This is being referred to nowadays as the short-term rental tax loophole. Why do we call it a loophole? Well, because unlike real estate professional status, if you invest in short-term rental properties, you actually can have real estate to be your side hustle and still be able to use your short-term rental losses against W-2 and other income. With respect to short-term rental properties, you actually don't have to be a real estate professional. In other words, we don't care how many hours you're working at your job. All we care about is your ability to meet material participation rules. In other words, as soon as you and your spouse meet material participation requirements, you can now free up all of your short-term rental losses to offset all types of income, including your W-2 income. But what are those material participation rules? Well, there's actually 7 different ways to qualify. I'm going to talk about one of the most common ways to do it, which is you and your spouse earning at least 500 hours on your short-term rental property. So if you guys are earning 500 hours in your short-term rentals, now your short-term rental losses from the tax returns become non-passive, which means it can offset all types of income. The question is then, what do I have to do to earn these 500 hours with respect to my short-term rentals? The easiest way to describe it is having hands-on time with respect to your rental properties. So when we're talking about short-term rentals, common examples would be staging the property, building the furniture, getting the guest set up, dealing with guest turnovers, maybe from time to time, doing cleaning and things like that. So depending on where you're investing, how close it is to you, what you're willing to do with respect to the property or even self-managing it, it may not be very difficult for you to earn 500 hours with respect to your short-term rentals. And the good thing about this is that you can actually combine your hours across multiple short-term rentals. So if you had 3 short-term rental properties, you don't have to have 500 hours in each of them. You can actually combine all of your hours to meet that 500-hour threshold. And if you're married, both you and your spouse's time counts together, assuming of course that you guys are actually actually doing the work together. Now, I talked about the 500 hours requirement, but there are actually, like I said, there's 7 different ways you can qualify. Another way is you spend at least 100 hours on your short-term rentals and nobody else has more time than you. And the third way to do it actually is you have any number of hours at all, as long as everybody else's hours combined is less than yours. If you want to know more about how you can meet material participation using 100 hours or even fewer than 100 hours, check out the description below with a link to my free tax savings toolkit, where I talk extensively about all those other different ways to qualify for the short-term rental loophole. Now, it's really important for us to understand what is a short-term rental for tax purposes, because we have to make sure we are investing in a short-term rental in order to use this specific tax loophole. And short-term rental, contrary to popular belief, is not every single property listed on Airbnb. Actually, the IRS doesn't care where you list your properties. They define it as a property where the average guest stay is 7 days or less. And this is a year-by-year distinction. Right now, you might have invested in a long-term rental, but you've decided, hey, the short-term rental loophole is going to work best for me. And so at the beginning of the year or maybe next year, you can turn it into a short-term rental. So absolutely possible for you to use this strategy, even if the property currently is a long-term rental. You can always change your facts to match what you want it to be to get the most tax benefits. So exactly how powerful is this? Well, let's go over an example. We had a client, both husband and wife were high income earners in the medical profession. When they first started investing in real estate, they weren't sure where they were going to buy, what they were going to purchase. And so when we started working with them on the tax planning, we determined, because they were both working full-time as W-2s, we said, hey, short-term rental is going to be something that's best for you. And because they were new to real estate, they wanted to make sure they really understood how all of that worked. They ended up buying something that's not too far from where they lived. And this was really helpful in terms of allowing them to earn those 500 hours in their short-term rentals. So in the first year alone, they bought 2 short-term rental properties, I think about $400 and $450 each. They did all the right things with respect to managing the properties, getting it furnished, staged it, dealing with all the guest turnovers, had amazing cash flow and appreciation in that first year. And with just 2 properties alone, smaller cabins, they had over $250,000 of depreciation from the real estate, from the furnishings, and all the write-offs. And so that alone saved them close to $100,000 in taxes just in that first year, just with those 2 short-term rentals. And what did they do with that $100,000 in tax savings? Well, they used it to buy another short-term rental property in that following year. This is a great example of how when you save on taxes, that's just more money for you to reinvest back into real estate to create more cash flow, more appreciation, more tax write-offs, and then rinse and repeat and do the same thing again. As you can see, there is so much power in real estate investing and how it can help you to not just build wealth through cash flow and appreciation, but also gives you massive tax savings too. And this is how generational wealth is built. Visit my website at keystonecpa.com to get free access to more real estate tax tips in our tax savings toolkit. If you like this video, hit the like button and subscribe for more real estate tax tips.